Ladies and gentlemen, good day and welcome to Indusind Bank Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumant Katpalia, Managing Director and CEO, Indusind Bank. Thank you, and over to you, sir.
Good evening, and thank you for joining the call. Let me start with some macro commentary and then go into bank-specific details. During the Q1 financial year 23, we saw economic activity momentum picking up sharply as well as headwinds to growth rising as well. The services PMI index signaled a very strong improvement in private services activity, while manufacturing sector activity levels were stable. Prospects of the farm sector also looked better with the timely onset of monsoon and output last year touching another record. Bank credit offtake too picked up over the quarter in line with an improvement in the underlying economic activity. However, rising inflation levels led to the monetary policy tightening by major global central banks, including India, which is likely to continue in the near term. Relatively strong economic growth prospects, a deleveraged corporate sector, much improved health of the banking sector, along with some strong external forex reserve buffer, and measures taken by the government and the RBI to curb inflation would help India negotiate these headwinds. Global supply chain pressures have begun to ease, and non-energy commodity prices are now easing. While the real GDP growth is expected to slow down in financial year 23, India will still remain among the fastest growing global economies. Coming to the quarter-specific developments, our focus areas for the quarter were continued loan growth and acceleration. We maintained a healthy loan growth of 4% quarter-on-quarter, driven by strong disbursements in vehicle, corporate and other retail assets. Microfinance disbursements too returned to normalcy after a brief hiatus to adopt to the new regulatory guidelines. We're thus seeing loan growth momentum in all the business units. This has also resulted in a year-on-year loan book growth, improving to 18% from 12% previous quarter. Maintaining deposit momentum. We achieved 3% quarter-on-quarter growth in deposit mobilization in spite of the liquidity tightening and increased competitive intensity. Our growth was driven by 16% growth in CASA, and CASA ratio improved from 42.7% to 43.1%. The retail deposit as per LCR also grew by 17% year-on-year. We also achieved the highest new customer acquisition of 425,000 customers during the quarter through Consumer Bank, ensuring healthy asset quality. We all have provided gross slippages segregated for standard and restructured book in the investor presentation. Our standard book slippages have reduced to 0.57% from 0.75% quarter-on-quarter. Our restructured book has reduced by 1,013 crores from 2.6% to 2.1% quarter-on-quarter. Our net NPA is at 0.67% with the provision coverage at 72%. Our contingent provisions are at 3,003 crores with total loan-related provisions at 141% of gross NPAs. Our credit cost has reduced to 50 basis points from 61 basis points quarter-on-quarter. Sustaining profitability of the franchise. We saw healthy net interest margin of 4.21% with both loans and depositing witnessing repricing during the quarter. Client fee income grew by 9% quarter-on-quarter, driven by continued retail momentum. Our trading income too was positive during the quarter. Our PPOP margin to loans for the quarter were at 5.7% versus 5.8%, marginally lower due to lower trading incomes. Steady improvement in return ratios. Our profit after tax grew by 16% quarter-on-quarter and 61% year-on-year to 1,631 crores. Our return on assets improved to 1.73% and return on equity was at 13.4% for Q1. With improvement in profitability metrics and lower risk density, our capital adequacy ratio improved during the quarter with CET1 at 15.96% to 16.05% with overall CRAR at 18.14%. Now coming to individual businesses. Vehicle finance. The vehicle finance loan business accelerated during the quarter to 4% quarter-on-quarter. The year-on-year growth too improved from 1% to 8% over the quarter. Historically, first quarter has been a seasonally weak quarter, whereas quarter 4 has been a strong quarter seasonally. However, we have seen disbursements of rupees 10,078 crores in quarter 1, which are higher than the March quarter. This is the first time in last several years we have seen quarter-on-quarter growth in disbursements in quarter 1 of financial year. The disbursements are also the highest in a quarter we've ever achieved. The segments showing strong disbursements are commercial vehicles, utility vehicles, cars and tractors. Disbursements are muted in the three-wheeler and two-wheeler segments. The disbursement traction also validates efficient capacity utilization of existing vehicles. Vehicle customers are also able to pass on increased cost of fuel to the end user. The recent oil price movement and also the tax rate cuts by various state governments provide further support to the freight economics. The collection efficiency of standard customers remains stable at pre-COVID levels. The slippages from the standard book were stable at 4.5 billion quarter-on-quarter. The restructured book in the vehicle finance has reduced from 3,298 crores to 3,131 crores quarter-on-quarter. The collection efficiency of these customers remain comfortable in the 80s as per our expectations. While the vehicle portfolio pricing is fixed term in nature, the fresh disbursements are at higher rates broadly in line with the benchmark movements. We have thus seen an overall yield on the vehicle portfolio improve during the quarter and expect the trend to continue in the coming quarters. The vehicle portfolio has now shown strong disbursements for 4 quarters in a row. The industry volume, however, are yet to reach the peak levels. We do thus see further scope of disbursement growth in the year participating in the overall industry growth. Microfinance. During the quarter, microfinance industry adopted RBI Master Direction on the MFI issued on 14th March 2022. Though the time available was short, necessary changes were made and we could commence the disbursements from May. We were able to recoup some lost sales and achieve disbursements of 7,531 crores during quarter 1. These are the highest quarter 1 disbursements in Bharat financial history. Our MFI book at the end of quarter 1 was at 29,403 crore, was up 11% YOY. Our MFI standard book collection efficiency for quarter 1 was at 99.1%, same as quarter 4 financial year 22. The collection efficiency for new clients sourced post-COVID too has also remained healthy at 99.2%, which is close to pre-COVID level. Our 30 to 90 DPD book, including restructured customers, was at 2.2% on June 22 compared to 2.6% at the end of March 22. Higher emphasis was placed on recovery during the quarter as we felt that the economic condition has sufficiently improved for our customers to start repaying their overdue loans. Through focused efforts, we were able to recover 57 crores during the quarter 1 against written off loans sold to ARC and expect to realize higher recoveries in the following quarters. The gross slippages during the quarter moderated to 560 crores as compared to 815 crores during the previous quarter. The slippages from the standard customers reduced considerably to 278 crores from 779 crores quarter on quarter. The outstanding restructured books has also reduced to 644 crores from 995 crores quarter on quarter. The restructured books saw slippages of 283 crores. We have utilized the contingent provision created last year towards these customers. Our merchant acquiring business under the banner of Bharat Super Shop continued the growth momentum. Portfolio sourced under this business has grown 15% over quarter 4 financial year 22 to 2,237 crore with 3.8 lakh active borrowers. The total disbursement during the quarter was 942 crores with continued demand from the missing middle segment. We see large opportunity in deepening relationship with these customers. The book has been performing relatively well with the standard book collection efficiency of 99.1% for quarter 1 financial year 23 and net collection efficiency of 97.8%. Our endeavor to take banking to the doorstep of the underserved customers in remote locations continue. At the end of quarter 1 financial year 23, the total liability book sourced from the customers and serviced through BFIL increased to by 134% year-on-year to reach 1,450 crores through 1.14 crore accounts with us. Our focus remains to be the banker of choice of customer segment in Bharat. Global diamond and jewelry business. The global diamond trade slowed down during the quarter due to Russia-Ukraine conflict and lockdowns in China, Hong Kong. Our diamond book grew 1% quarter-on-quarter and 28% year-on-year and forms 4.2% of the overall loan book. The disruption, however, did not have any impact on asset quality, with no clients getting into SMA category. The industry is working closely with policy makers for normalizing the supply chain. The recent development steps by the government and the regulators to facilitate trade between India and Russia should improve the flow of rough diamonds. Overall, we remain comfortable on the diamond portfolio except for further growth to continue as the supply chain normalizes and markets in the PRC open up. Corporate book. A corporate book maintained healthy growth trajectory of 4% quarter-on-quarter growth. We saw growth across segments, with large corporates growing by 3%, mid corporates by 5%, and small corporates by 11% quarter-on-quarter. Loan book growth was broadly driven by the large corporate segments like strategic client group and financial services, and in the mid and small corporates like SME and healthcare. Majority of the corporate loan book is floating rate in nature, and we were able to pass on increased rates for customers due for reset. Our yield in the corporate book thus improved by 7 basis points quarter-on-quarter, reversing the past trend of falling yield. The portion of A and above rated customers has improved from 70.6% to 73.5% year-on-year, and weighted average rating improving from 2.68% to 2.63 YOY. The net slippages in the corporate book were 4.1 billion for the quarter. This includes, as mentioned in the previous call, some group companies of a retail corporate amounting to rupees 2.5 billion which turned NPA during the quarter. Our corporate restructured book has now reduced from 9.6 billion to 5.6 billion quarter-on-quarter. Exposure to stressed telco, which was at 18.5 billion, including fund-based exposure of 10 billion and balance non-funded exposure. We do see continued interest from corporate towards capex plans. Impact of interest rate hike is not felt strongly as budgeting was done with the assumption of interest rate hikes. We see interest in capex plans, particularly in segments which have deferred capex due to COVID, such as auto components, steel, renewable, etc. Capex is also seen under PLI schemes in electronics, mobile, distilleries for capacities being put up. Business momentum also remains strong in small corporates and SME segments with focus on new acquisitions, supply chain financing, etc. Elevate on a small base. We are watchful of segments impacted by higher inflation. There are however segments witnessing tailwinds, example export-oriented units, infra, textiles, etc., which provide opportunities for growth. Overall, we do see corporate book to maintain a steady growth driven by mid and small corporates with active repricing benchmark to the market rates. Other retail assets. We saw another quarter of growth momentum in other retail loan book, growing by 7% quarter-on-quarter and 23% year-on-year. Within secured assets such as business banking and loan against property, which had seen intense competition over the last few quarters, both in terms of pricing and collateral relaxation. With rising rates, environment and inflation, we are seeing underwriting improving. Our acquisition run rates continue to accelerate. Credit card spends have remained strong for us as well as industry spends of 16,900 crores for June. We also saw the highest ever card acquisition of 75,700 in June, with credit card base crossing 2 million mark. We expect growth momentum in retail businesses to continue in the current financial year. We do, however, remain watchful of inflationary economic conditions, particularly on the unsecured consumption spend. Now coming to liabilities. Our deposit grew 13% year-on-year, driven by 16% year-on-year growth in current and savings account, and retail deposit as per LCR also grew by 17% year-on-year. The quarter was also marked by interest rate hikes and heightened competition for deposits. We also saw larger peer banks raising their term deposit rates and in some cases saving deposit rates too. We have been selective in our rate action and seen the rate gap with larger peer narrowing during the quarter. We have ramped up our deposit acquisition with new client acquisition from consumer banks touching a new height of 4.25 lakhs for the quarter. Our term deposit monthly run rates have moved from 78,000 to 1,15,000 quarter on quarter. Our CASA ratio has improved to 43.1% quarter on quarter, driven by 19% growth in savings accounts. Contribution of certificate of deposit remains low at 3% of deposits. Our affluent segment deposits grew from 35,300 to 36,300 crores during the quarter. Affluent AUM was stable at 59,000 crores despite the market correction. Deposits from NR segment have remained stable at 26,800 crores. The NRI momentum is expected to pick up with the recent regulatory guidelines. We let go of borrowings during the quarter, reducing by 12% quarter on quarter and 15% year on year. The borrowings now form only 10% of the liabilities and almost all are long-term in nature. We also repaid our Euro MTN program in April and thus we don't have any foreign currency bonds outstanding. We also exercised a call option on additional Tier 1 bond at the earliest permitted anniversary of 5 years. Overall, we continue to remain focused on the retail liability mobilization. Our physical and digital distribution priorities have been aligned towards retail deposit. We are aiming to take the branch distribution to 2,500 by March 23. We continue to scale up new initiatives like affluent and NRI. We are confident of maintaining a deposit and cost of deposit profile to fund our loan growth aspirations. Digital traction. Digital sourcing percentage across products continue to increase, and what is interesting now is that we have started building and scaling up digital unassisted models with focus on scale with profitability. During the quarter, more than 200,000 clients were onboarded using video KYC. 96% of bank savings accounts and fixed deposits are originated digitally. Of this, 30% of savings accounts are opened in a digitally unassisted manner through marketing of direct-to-client platforms, and 40% of fixed deposits originate in a digitally unassisted manner. Easy Credit Stack continues to scale, bringing in fresh volumes as well as reduce the cost of acquisition. 90% of cards are originated digitally now on the back of Easy Credit at a cost of processing which is 60 to 70% lower per unit. We recently went live with Easy Credit for personal loans as well, and 54% of personal loans are originated digitally, which will be scaled up to 90% within the next few months. We continue to focus on increasing digital transaction intensity and increasing the clients digitally. 92% of the branch transactions are digital. Mobile transactions have increased more than 2x YOY, and mobile active base has increased 21% YOY. On WhatsApp banking, we scaled up our user base to more than 5 million. We offer more than 50 services on WhatsApp, and our WhatsApp transactions increased to 45% YOY. In terms of new launches, Indus Merchant Solution app has scaled up to a user base of 80,000 plus retailers, and every second user on the app is a new to bank, suggesting strong pull of the product in the market. Indus Easy Credit for Business Stack is also scaling up steadily, wherein we offer small ticket business loan and secure overdraft to clients. As a result, nearly 40% of our MSME lending in less than 2 crore exposure bucket is now digital, and we plan to make it 100% digital with the expansion of working capital product suite over the next couple of quarters. We are progressing on remaining 2 launches for digital 2.0, that is for individuals and for SME. They are expected to be launched in the second half of the year. As we build capabilities in our digital platforms and applications, we also leverage the underlying API to integrate with partners and ecosystem to boost our banking as a service model. Now coming to the financial performance for the quarter. Net interest income grew by 16% year on year and 4% quarter on quarter, in line with the loan growth. Net interest margin improved sequentially from 4.20 to 4.21% quarter on quarter. The net interest margin was supported by repricing on the asset side as well as active management of the liabilities. Our consumer as well as corporate loan book saw yield improvement during the quarter, with overall yield on loans improving by 10 basis points. While the cost of deposit decreased, increased by 19 basis points. The cost of funds increased by only 6 basis points due to reduction in our borrowing expenses. Other income grew by 12% year-on-year and 1% quarter-on-quarter. Core client fees excluding trading income grew by 9% quarter-on-quarter and 7% year-on-year. Our trading income was down quarter-on-quarter and YOY due to rise in interest rates. We have nevertheless saw positive non-core income of 146 crores during the quarter. Share of retail fees improved to 70% from 64% of total fees. Our total revenue for the quarter was rupees 6,057 crores with 15% year-on-year growth. Operating expenses grew 5% quarter-on-quarter with continued recovery in the business momentum. Our overall cost-to-income ratio increased from 42.6% to 43.4% quarter-on-quarter due to lower trading income. Our core cost-to-income before trading income improved from 45.4% to 44% quarter-on-quarter. The operating profit for the quarter was at 3,432 crores, growing 10% year-on-year and 2% quarter-on-quarter. The PPOP margins to loans continue to be healthy at 5.7%. On the asset quality and the provisioning front, our provisions for the quarter have further reduced to 12.5 billion. The provision to loans are thus down to 50 basis points now. We saw reduction in slippages from the standard book from 17 billion to 13 billion. The reduction was driven by lower slippages from microfinance and corporate customers, whereas vehicle and other retails were stable quarter-on-quarter. The restructured book slippages were driven by microfinance customers coming out of eligible moratorium and also retail group in corporate banking. We also made contingent provisions against these last year and have utilized to the extent of slippages. The restructured book has reduced by 10 billion during the quarter from 2.6% to 2.1%. We did not have any sale to ARC during the quarter. The net security receipts have reduced from 83 basis points to 72 basis points. Overall, the gross NPA for the bank was at 2.35% and net NPA was at 0.67%. We have maintained provision coverage ratio of 72%. Our contingent provision excluding specific provisions were at 3,003 crores. We have utilized 325 crores towards slippages during the quarter from the restructured loans as explained earlier. Total loans related provisions are at 3.4% of loans or 141% of the gross NPAs. Our SMA1 and SMA2 book was at 10 basis points and 39 basis points respectively. Profit after tax for the quarter was at 1,631 crores, growing at 16% quarter-on-quarter and 61% year-on-year. Our CRAR including profits remained healthy at 18.14%. Return on assets continued upward trajectory from 1.51% to 1.73% quarter-on-quarter and return on equity improved to 13.4%. I also want to spend a minute on the stock exchange intimation done earlier this month on media speculation. As disclosed, this pertains to an old investigation. The bank is providing the necessary support to investigating agencies. The matter was also scrutinized by the regulator in the past and the outcome of the same was intimated to the stock exchange in 2016. The bank is not named as a party in the first information report. Given the investigation is in progress, there will be limited scope for further information beyond what we have already disclosed. Overall, the quarter saw turbulent operating environment with interlinkages of inflation, reversal of accommodative monetary policy and Russia-Ukraine conflict playing out. The first quarter was also a seasonally weak quarter for some of our businesses. The bank has nevertheless focused on delivering our PC5 ambition. Loan growth has accelerated to 18% from 12% last quarter. Our vehicle and microfinance had the best quarter one disbursement in their history. Consumer and corporate books are delivering steady growth. Asset quality trends from standard book continues to improve. Restructure book carries comfortable contingent provisioning. All key portfolio metrics across NIMs, core PPOP margin, ROA, ROE has maintained positive trajectory. We continue to invest in new initiatives like affluent, NRI, tractors, merchant acquiring and plan to launch the home loan this quarter. We will also launch the remaining two of the planned digital initiatives during the year. We are thus committed to deliver our PC5 ambitions of achieving 15 to 18% loan growth CAGR and maintaining a healthy PPOP margins upwards of 5% and reducing credit cost towards 120 to 150 basis points. We can now open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Maruk from Edelweiss Broking Limited. Please go ahead.
Hello, sir. Congratulations. So my first question is, if you could explain fees. So there has been strong growth in general banking and third-party distribution fees. So if you could give some color on that, that's my first question, sir.
So I think when you look at the fees, you have to look at the general banking fees has multiple components. One is the regular deposit processing fee. The second is the payments, and the third component is the PSL fee. You know, the PSL certificate. I think it's a combination of all the three which has increased. Of course, the PSL increased by about 50 to 60 crores in the quarter, and that is what has added to that growth exponentially. On the distribution side, I think the growth is normal, and it's actually the core businesses which are growing, which is the health, the insurance distribution, the card distribution. So that's what has grown, and that is what is categorized in the overall fee, and that's what has grown.
Okay, so that looks sustainable, at least for a few quarters, right? Okay.
Yes. So so it's about 8% quarter-on-quarter growth.
Correct, sir.
Yeah.
So my next question is in general on outlook on growth, right? So the if you see the banking sector growth, or if you listen to the commentary of banks, they remain quite optimistic on growth, whereas investors generally remain concerned on a slowdown. So how do we tie in the two?
So, in my opinion, you have to see the growth coming from which segments, and that's how you should link it. So, if you look at our vehicle finance business, and if you talk to the OEMs, all of them are projecting a high growth because they're coming from a cyclical downturn. For 2 to 3 years, they've seen a downturn. So I think you will see growth coming back in this segment, and of course, also fueled by our entry into the used car markets, our tractor business seeing the scale up in those segments, and the medium and the light commercial vehicle which we have entered, and we've now got an 8% market share, seeing a scale up to some extent. So I think you will continue to see a 16 to 18% growth in this segment for us, and we will continue. In microfinance, I think there's enough demand. I think the demand was affected this last quarter because of the RBI regulations, and there was a system modifications and which was happening. I think the first 45 days were lost. The last 45 days is where we did the disbursements, and I think you should see a 25 to 30% growth happening in this segment. It also will be fueled by our entry into the merchant acquiring segment, where we are seeing a very rampant growth, which is 2,300 crores when we expect to close the year at 4,000 crores. So that segment is also going very fine for us. And diamond, of course, once the rupee trade and the regulatory changes happen, you should see the growth coming back, and I think that got affected this quarter. Corporate side, I think the SME and the MSME segment, we are seeing good growth, and on the large corporate, while there is growth, I think the pricing is still very fine, and we continue to be very careful in what we are doing. I think we are getting 3 to 4%, and we'll go in line with the market, or maybe a percentage point higher, because we come from a very small base.
Got it, sir. Sir, my last question is on corporate slippage. So where would you see it normalize per quarter, like a broad run rate? Of course, there was slippage from restructured of 250 crores, which was pertaining to the group which you had mentioned last quarter only. But where would the corporate, now most of the restructured corporate loans also would have slipped, right?
Correct. So I think the corporate will, you see, these are one-off specific cases which have come in and which are affecting the corporate, and you know which group I'm talking about. And I think that's the flow which happened this quarter, and there was one group, more item which happened, which actually got upgraded during the quarter itself, and you would see an upgrade also in that quarter itself. So I think otherwise you should see corporate normalizing. We are not seeing any high indicators of any such fresh flows which are coming in. I think it will be a BAU, and the BAU flow, we've always said corporate will fluctuate between 30 and 50 basis points, and that's where it will be.
Got it, sir. Okay, sir. Thank you. Thanks a lot.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. So, questions. So, firstly, currently now, how much are we carrying in terms of the provisions on the restructured pool?
We are carrying 3,003 crores as contingent provision.
Contingency. Yeah, so contingency. So we can assume that maybe larger part of it is towards the restructured. So as and when maybe there is a flow through from the restructured, contingency will keep on getting utilized the way it has happened in this quarter.
We don't utilize full. We see how it is. Our objective is to our guidance is 120 to 150 basis points. I also feel, for example, in microfinance, most of the restructured pool, the moratorium is over. They are paying. Whatever had to flow in has flown in. What will get another 50, 100 crores maybe will flow in. Otherwise, we are back to, in the CFD book, the vehicle finance, we've always said 20% will flow in. And that is what is flowing in. It's not that we are seeing anything else which is flowing in. So I think except for the future group, the one corporate group which actually flew in, there have been no surprises for us in the restructured book.
Okay, got it. And in terms of this BL, PL and HL, now that component is also quite huge, and there has been a good pickup in this segment. So you can highlight maybe amongst these three which is growing, and given that now that scale is also quite high, 11,000 odd crores, would we tend to break it down further?
Yes, so I think PL is growing. I think we have seen a 300 to 400 crores quarter-on-quarter growth on the PL side of the book. We are seeing merchant loans, which is about from the Bharat Financial, where I think we have seen a 15% growth in the merchant acquisition, which is growing. I think we are seeing an affordable, smaller businesses like BL, LAS and GL, they have grown quarter-on-quarter by 32%. And KCC, again a 3.5% growth quarter-on-quarter, which has come in. So I think all these businesses have started growing well, and we will see more growth as we go forward in these businesses, and we are diversifying our book for secured as well as unsecured. So this is why these businesses have been put, and they are growing very fine now.
We'll split from the next quarter.
If you want the split, we can send you the split over the mail also.
Yeah, because now that's becoming quite substantial. Yeah, so that would be great if that can be shared going forward. Yeah, and lastly, in terms of the branch expansion, so again, maybe almost. We are looking to add more branches. Maybe it was not a substantial one in Q1, but you highlighted 2,500 by the end of this fiscal. And we have seen OPEX also growing sequentially now 5% and catching up the pace with peers. So how should we look at cost to income? Now, would we see that going up with this investments getting into the branches and the employees?
So I've always said that our income growth will also match our expense growth at some point. So I think that's what you will see. Our microfinance, unfortunately, did not grow this quarter, but you will start seeing the growth. I think our cost to income will be range bound between 41 and 43%. Of course, in some quarters, you may be 30-40 basis points here or there, but our objective is to come down. We added our branches infrastructure cost came in. I think our resources, if you look at, we added 3,200 resources last year, and we've already added 927 resources this year. I think our cost on technology specifically is going up, and I think that's about 6 to 7% of our overall cost now. So it's increasing, and I think once our operating leverage of vehicle and MFI starts coming in, I think we should still come back to 41 to 43% range, which is what we are headed for, and that's the guidance which we have given.
Sure. Okay. Thanks a lot and all the best. Yeah.
Thank you. The next question is from the line of Adarsh from CLSA India Private Limited. Please go ahead.
Hi, Sumant, the team. Congrats on good numbers.
Sorry to interrupt you, sir. Your audio is not very clear. May I request you to speak through the handset?
Yeah. So thanks. I'll try that. Sumant, a couple of questions. One on liabilities. This kind of tough period in the sense that a lot of wholesale deposit costs would have moved up sharply. So just wanted to understand, is a lot of that already there, or we will see some of that impact come through in the next few quarters?
So a lot of bulk deposits are smaller duration, 90 days to 180 days. So I think you will see some part of it also coming in next quarter. It's not that because I think if the cost goes up and by 50, if the RBI increases the cost by about 30 to 50 basis points, you will see that impact on the book coming in. So I think we have taken that into account while we're preparing our quarter 2 and quarter 3 going forward. So we've taken that into account, and we still believe that even if the cost of deposit, we have enough assets and our strategy to make sure that our NIMs are within range bound between 4.15 to 4.25.
Perfect, Sumant. And my second question related to the restructured book, right? So a lot of the reduction was slippages in this quarter. So as you said, a lot of it, what had to slip has slipped. How does this 2% of restructured book wind down? They perform for a year, they wind down, or when do we know that what was the outcome from the full book?
Quarter on quarter, you will start seeing the winding down. I think, but I think by March of next year, which is the financial year 22-23, you will see 70% of the book winding down to a large extent, because I think the payments would have started. And what I had to go down will go down. We've always said that we provided extra, and I don't see our restructured book cost actually crossing more than 1,100 to 1,300 crores. So that's what our thing has been. We've only utilized up till now 325 crores. We've always said that we will keep extra buffer and keep 2,000 crores safe, and I don't think we need to utilize anything more than that on our restructured book. So that if you think of it, overall is 15 to 20% of the restructured book, which is original, which is what the cost will be.
Perfect. That was helpful. And just to follow up on margins, Sumant, that we've seen unsecured mix pick up for us. CVs is doing well. MFI will likely come back. So from a loan mix perspective, the levers are there for margins to do well, right?
See, we have always maintained certain things. We've always balanced our book. Our overall unsecured book to the overall loan book has always been less than 30%. We've always maintained the ratio, and the unsecured book, which is credit cards and PL, in the consumer bank has been less than 5%. We've not let that bust, because we have a microfinance book which we have always said to the market can go up to 15%. So I think those are the levers which we have used, and I think we have some headroom there, but I don't think you will see us busting those levers ever.
Got it. This is useful. Thanks, and all the best, Sumant.
Thank you. The next question is from the line of Nitin Aggarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, Sumant, first question is around the treasury performance of the quarter. That looks quite strong in such a challenging time. So, any more color as to what has really driven this profit on the treasury line?
I think first of all we must admit that we've done well on treasury, and we run a very good treasury book, and I think we manage the book well. Arun, who's here, who's our deputy CEO and who runs this business also. I think Arun.
Yeah, I think way back in January onwards we started unwinding all duration portfolio, and I think as a conscious decision we did not do any of these, or we did very insignificant sort of non-SLR bonds. And by March, April, we had already unwound everything. So by April, actually, all our positions were unwound when it came to this thing, and we had switched them into mostly treasury bills. And that's why we did not really take a hit on any of these positions, but yet tried to some revenues with the positions that we carried, and we spread them off in first week April to second week April.
Sure. And secondly, Sumant, Indusind Bank has been putting a very resilient performance over the last several quarters. Every time there will be all the other concerns popping up, macro approach has not been great as well. So going into FY23, as we look to do better on earnings and growth, what are the top 2-3 things that will be most watchful?
What are the top 3 things that are most watchful for you for the current year?
I think 3 things which I think we have to be watchful is, I think we've given a guidance on credit cost. We want to remain within the guidance of 120 to 150 basis points. And I think that's one thing we are very... Second is, I think, on the first thing itself, you check out the flows. And I think the standard book flows have normalized. While, our flows have increased because of the restructure, I think people have to understand, and I think the message is our standard book has normalized and is improving every quarter on quarter. And that is something, a message, and please look out for that. The number 2, I think I'm very watchful is that I think we manage our mix in such a way that we are able to maintain in the NIM range which we have guided. And I think cost of deposits, like you've seen this quarter, has seen an increase. We manage the cost of funds very well, and I think we have to continue to manage the balance between cost of deposits and cost of funds to make sure that we are within this range and manage the mix of the portfolio. The third thing, and I think which is a lot more important, I think we have to be watchful of our cost. I think while we continue to invest for growth and we never stop our investments, I think technology cost, and with the launch of the new initiative on the individual side coming up in the third quarter of this financial year, I think you will see some expenses on the marketing side which will build up. And I think our data center migration is also in line. So we have to see how are we going to manage these costs as we move forward. So I think these are some which we are looking forward to. I may necessarily not say the costs have to match. I think the growth in the income has to be much better than try and manage the investment cost. So I think I always look at it that we're too small right now to start managing costs. I think in these areas, I think for us, the growth in income is more important than growth managing the cost as of now. Am I? Nitin?
The next question is from the line of Mr. Manish Shukla. Please go ahead.
Thank you for the opportunity. First question, Sumant, if you could please break down the slippages and restructured book by segment again for the current quarter as well as the previous quarter.
Yeah. So you can take down the gross slippages. I think the gross slippages in quarter 4 financial year. So I'll go by the segment. So CFD, which is the vehicle finance book, we had 450 crores of gross slippages in quarter 1 financial year 2023 against 453 crores in the standard book. We had 235 crores of slippages in the restructured book in quarter 1 against 100 crores in quarter 4.
I think it will be easier if I just upload that table along with the commentary.
Yeah, that will be perfect. Thank you.
I'll upload that table.
That will be much easier. Yes. Second question, Sumant, is that on the granularization of the liabilities, right? The share of retail in total LC as per LCR has been hovering around 40-41%. Now that we are in a rising rate environment and every bank is going to chase deposits, what are your thoughts on increasing the share of retail in overall deposits as reported under LCR?
So we've said we want to achieve 45%. And that we are committed to achieve 45%. I think there are 4 or 5 initiatives which we are backing this up with. I think the NRI, unfortunately the NRI flows have been stable over last year or the previous year also because of the moving targets. I think you will start seeing the NRI flows coming in, and with the regulations changing or RBI giving the dispensation on the CRR and SLR, and I think some more dispensations will come in the forward or the swap rates, and I think you should see the growth coming back in that business. We are targeting a good growth out there. as a consequence of that. That's number one. The second is the affluent piece. I think the affluent piece also saw some, while the growth in liabilities has been strong, I think they can do much better, and I think we are committed to achieving our numbers on that. That should see a growth. Our acquisition run rates have increased, and I think we are seeing around, in the branch banking side of the book, we are seeing about 125 to 150,000 accounts on savings account, which should move to about 200,000, and I think the acquisition run rate will itself increase the balance sheet in itself, along with the new branches. The fourth is the Bharat Financial book has started increasing, and if the accounts getting open, I think we are already seeing a 200 to 150 crores, which is, if the disbursement starts happening, I think you should start seeing a 350 to 400 crore quarter-on-quarter growth in this business, which is along with the merchant acquiring business. And the last is the digital piece, which I think will get launched by November, December, where I think we will start talking about a scale in a different way. So what we are doing with the branch banking today, I think we'll double of that we will start doing in the digital. We'll start doing 200 to 250,000 accounts a month to up to 3 million, and that I think will set a new benchmark on how our balance sheet. So I think we are well prepared to take care of our growth as well as the retailization piece which we are moving towards.
Okay. And my last question is on the entire MFI whistleblower episode. Whatever actions had to be taken from your end, those are largely done in terms of either making procedural changes or making provisions, or is there anything which is still remaining?
Nothing is remaining. In my opinion, the only thing which is remaining, we are doing for a system upgrade, where I think by March 23 we would have done a system upgrade also. So I think that's the only thing which we are doing. We are making it much more robust, and I think we are adding much more features and control secure features into that. That will happen by March 23. Otherwise, all changes in the organization structure, processes, as well as what needed to be done have already been done.
Sorry, one last question is, in the MFI book, there is a quarter-on-quarter uptake in ticket size from about 27,800 to 29,700. Is this because of the new RBI norms, and should this be the new normal?
No. I think what has happened, the acquisition of new to bank client, actually which was 800,000 to 900,000 a month, went down this quarter to 500,000. The cycle 1 ticket size is actually 18 to 20,000, whereas in cycle 2 it's 30,000, in cycle 3 is 35. So what has happened this quarter is that the cycle 2 and cycle 3 have been successful. Our new to bank customers have been lower than what they are normally, and as a consequence the ticket size has moved up.
Understood. This is very clear. Thank you very much. Those are my questions.
Thank you. Next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, thanks. Hi, Sumant. I think most of the questions have been answered. Just one observation. If I see a slide number 25, the write-offs in the corporate book appears to be on the higher side. So pardon me if I'm sort of repeating this question, but can you sort of explain what sort of triggered such a large write-off number? I'm sure this is an aberration.
No, not at all. I think you're absolutely right. There are two accounts which have gone into the write-off. One is a media account, which was there, which we had taken a provision long time back, and we had to write off because of the IRAC norms. And the second one was a real estate account, which was had to be. So both of them have been written off as a consequence.
Got it. Just that I have the floor, maybe one or two more questions. On the deposit side, again coming back, right? So you've got the levers on the yield side across portfolios, with pickup in high yielding portfolios, etc. I hear you on the NRI deposits, etc. But anything that goes beyond, building the customer base, which is far more sticky and allows you to diversify in your retail asset mix at a future point of time. I mean, any strategy or anything that you're sort of doing out there to improve that part of the segment so that the business becomes less cyclical?
Yeah. So I think I told you, I think while the branch banking is doing, which is, all the levers, which are, mobile payments and all of that is happening, I think the digital piece will create a very super engagement strategy. And we are coming with a completely different UI UX and a payment stack, which will redefine the client experience, product, as well as the business plan strategy on the liability side. It's the client experience does not start from liability. It can start from a very different journey and end up because of the transactions going through the payments to going through the bank. And I think as a consequence, we believe while the ticket size may not be equivalent to what our branch gets of about 62, we have taken a 30,000 of about almost 50% decline in the tickets. I think it's the volume which we are planning to do, and I think we will acquire about 2.5 to 3 million customers per year through this strategy. And I think as we go forward, you will see a very differentiated CASA mix as well as the bank going forward in the liability strategy. And I think we believe that's going to be the change agent for the bank going forward in no way am I saying we will stop expansion of branches. No way am I saying that branch distribution is not important. I am saying it's a mix of both the strategies which work together and creates a very differentiated offering. And of course, in the current account side, you would have seen the merchant acquiring business. And I think as we scale up this business, 30% of the client flow go through it. So the AUM which is there in the merchant acquiring business, which is about 2,300 crores, about 30% of that book lies with us in the current account book. We want to scale this business up to about 15,000 crores in 3 years' time, and you will see that the flows in the current account as a consequence will start coming in. And as we grow more deeper into our saving MFI penetration, while the book may not be booked, the cost of that book will be very, very good as we go forward. And I believe that we should be able to create a 5,000 to 6,000 crore book in the next 2 years in this. We are already at 1,500 crores. So I'm seeing a very good potential which is coming in as a consequence of these efforts which we are doing.
Understood. Appreciate that. And just on the deposit bit again, or the deposit pricing rather, over the next few quarters, of course, given that, everybody's sort of, fighting for deposits, how do you see yourself playing in that market? I mean, would you need to offer substantially higher rates, or you're comfortable with whatever rate differential you're running with versus the larger banks, and that should be enough to generate enough volumes to support your loan growth?
So if you look at our loan growth, we are talking about, even if we do everything, even if we do 20%, we're talking about a 50,000 loan growth, which means that we have to convert this into a 60,000 crore of liabilities. That's what we need to convert it into. If you look at our growth, we're today at 10,000 crores or 12,000 crores, 10,000 crores of growth. I think for that we need another 5,000 crores. And you will see us maybe solving that, rocking that situation in the next 2 quarters itself. And so the way we are going, I don't see that as a risk if all our strategies play out, and I think we're not seeing that risk. Having said that, I think I've always said that initially we were 200 basis points ahead of the market during 2020-21. We reduced it to 150 basis points, and now I've said we will be 150 to 75 basis points ahead of the market. And that's where we want to be. And I think we've been able to attract deposits at that level. And I think we should maintain that. If the situation gets worsened, I think we will come and inform. But we will also change our mix in such a way that we have changed the mix of the business in such a way that we are able to take care of the deposit price.
Great. Look, congratulations for a good quarter, and thank you so much for the responses.
Thank you. Next question is from the line of Sameer Bhise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one clarification on the vehicle finance book. So the sequential accretion in the loan book appears a bit more pronounced versus the fact that disbursements were flat QOQ.
Yeah. This is what we have been explaining for last 3-4 quarters. The way the EMI construct works, if the previous year disbursements are low, the runoffs are so high that even the higher disbursements can't catch up. And once you have delivered 3-4 quarters of consistent disbursements, then you don't have to keep on growing disbursement. It keeps on building up. So it's purely because of that construct that you have seen the disbursement versus loan book movement over the last 3-4 quarters.
Okay, sure. And just secondly, on the corporate side, what sectors are you seeing the incremental opportunity?
Sanjeev.
Yeah, I mean, we are basically there's on the large and mid-sized corporates, so it's across the auto sector, the renewable space, the government push on infra, the PLI scheme. So pretty much it's across everything, and there are big capex kind of plans lined up.
Okay. And just about the slippages on the microfinance side, could you split it between from the restructured book and even from the standard book?
So we are uploading the information, but I can tell you that quarter one slippages 278 came from the standard book and 283 came from the restructured book out of the 560 crores of slippages.
Okay. Thank you and all the best.
Thank you. The next question is from the line of Jay from B&K Securities. Please go ahead.
Yeah, hi sir. Congratulations and thanks for the opportunity. Sir, if you can...
So sorry to interrupt you. May I request you to speak a little louder, please?
Thanks for your call. Please stay on the line.
Due to hold music, we move on to the last participant. The next question is from the line of Rakesh Kumar from Systematics. Please go ahead.
Yeah, thanks for the opportunity. Can you hear me?
Yeah.
Yes, sir. Just extension to the previous question in relation to the regulatory disclosures that we make on NSFR and LCR. If I see in NSFR, the staple deposit composition is, relatively on the lower side and looking like an outlier as compared to, the bank of a, similar size. So how we are going to, change this, deposit composition profile maybe in a times to come. And second thing is that what we have seen in last, 10 years, 12 years performance that, after a rate rise, in the subsequent years, there is a margin pressure because your deposits are then, priced at the higher rates, and then we see.
I think you have to look at it in two ways. I think if you look at, you're absolutely right. If you look at our retail LCR, it's on the low side, and that's something which we've done it on purpose, and we are now increasing it, and we've made it as a part of our PC5 ambition as well as going forward. And I think our LCR today, if you look at it from a Basel III, it's 41%, and we want to go to 45 and eventually settle at 50% at some point of time. And I think that's where we are headed. And I think as that happens, I think you will see it. The other thing which you will see is if you look at our CASA ratio, I think one of the things which you will observe is that our current account percentages are lower to a large extent, whereas anybody else who's there would be around 30 to 35% of its book in CASA, and this will come out of the current account. And I think that's where I think you will start seeing a focus on the current account business, and that itself will start driving the margin as well as going forward. So I think 3 or 4 things, I think you will start seeing us focusing on retailization of liabilities. The second is the current account book, which has almost been stable for last 4-5 quarters or declining. You will start seeing a growth in that book as we go forward. I think the third thing is, I think you will start seeing that as your CASA percentages move up, I think your cost of deposits will start going down and your margins will come. Fourth, I think we've always said that we have the capability, and we may not have had it last time. I think we have the capability of creating a distribution mix through our domain specialization, where we can change the mix very fast to manage our NIMs as we have gone and margins as we move forward.
Got it, sir. Just one more question, if I could ask. This is with relation to the risk weight of the of the credit and the proportion of the loans which are on the risk weight of quite a lot of drop in that kind of a loan. Q1 NSFR is not yet out. But looking at these two numbers, it is looking that we are trying to get into the credit which is higher risk weight, at least from the 2 quarters numbers that we have.
Just to give you, I think if you look at, and it's a part of the commentary, our A-rated and above book has actually increased, by 300 basis points from 70% to 73%. Overall, our risk-weighted asset year on year has gone down. Risk weights have gone down. So I'm unsure as to where you're coming from. Of course, we have increased our SME and the MSME book also, but as a percentage within our this, it has not increased. So don't know from where it's coming. Maybe you can send us your question and we can investigate and get back to you on this.
So for example, RWA growth is 11%, whereas the loan growth is 18% year on year. The credit RWA growth is 12%. So the risk intensity has actually come off over the last 12 months. But I can engage with you separately offline and discuss with this.
Sure, Indrajit. Sure, thanks. Many thanks.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. And I'll hand the conference over to Mr. Sumant Kathpalia for closing comments.
So thank you for participating in the call. As usual, Indrajit and me are available for any other further clarifications that you may require. We'll upload the one statement which we have to upload by the end of day or tomorrow morning earliest. So thanks a lot for participation. Thank you.
Thank you very much. On behalf of Indusind Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.